We're here today to discuss a specific case and deal with both the U.S., the U.K., and the Swiss issues that pertain to this case. So let's look at the case. We have Fred, the settler of a Nevis trust, who is a U.S. citizen, currently living in Switzerland, set up 10 years ago, and he has been living in Switzerland for the last 35 years, married a Swiss national, Wilma. And at the end of the year, both Fred and Wilma plan to move to England to spend more time with their grandchildren in England. Fred, who is the primary beneficiary during his lifetime, and at death, his wife and children are secondary beneficiaries. So you've got to remember that Fred is an American citizen, and he is the one who is set up this trust in the first place. So we have one UK resident daughter, Pebbles, living in England, and one son, Bam Bam, living in Switzerland. Both are US-Swiss dual nationals. Fred transferred $50 million to his trust, which was 100% ownership of, the trust owns 100% of a US LLC, which owns US real estate. It owns 35% interest in a Luxembourg mutual fund and 25% interest in UK real estate partnership, commercial real estate. And it owns 100% of a Bvi Corp, which has 30 million of publicly traded stocks and bonds. Wilma, the settler of a US trust, okay, you got to remember, she's a Swiss national, okay? She settled a US trust written under the laws of the United States, governed and controlled by Wilma living in Switzerland. And the trustees are either in Switzerland or Nevis, depends on which lawyer you're talking to. And Wilma is the primary beneficiary during her lifetime of her trust, and at death, her husband, son, and daughter are secondary beneficiaries. Her trust owns 100% of a US LLC, which owns foreign stock and bond portfolio. It owns 100% of a US LLC, which owns art stored in vaults in Switzerland. And her trust owns 100% ownership of the Bvi Corp, which owns a US stock portfolio. So that's kind of the crazy estate planning these people received. And so let's start the discussion.
All right, thank you very much, Darlene. So I'm going to start from a 30,000-foot level and provide you with some basis or law here in the United States. So we actually have two tracks to consider here when we're doing planning for clients like Fred and Wilma. They sound so familiar. I feel as if I know them already. It seems like he made a lot of money in rock quarries years ago. Anyway, so two tracks here. One would be the U.S. transfer taxes, or what we would commonly refer to here as the estate, gift, and generation skipping tax, and you have to be concerned about that. Those are what we would refer to as excise taxes, and they occur upon events. So death would be an event that we would be concerned about, or lifetime transfers would be an event that we'd be concerned about. Then we have the U.S. income tax issues as well, and there's a whole bunch of issues that we would need to consider, which are going to be too vast to even discuss within a short period, regarding Fred's holdings and U.S. income tax consequences, and also what happens after Fred passes away, and the same thing with Wilma as well, and concerns that we have on her side and the assets that she owns. So first of all, we're told in the facts that both of these trusts, the one that Fred created and the one that Wilma created, are revocable trusts. So they can be changed at any time. Fred and Wilma have retained complete control of those assets, okay? So first, for both U.S. income tax purposes and in general, in general for U.S. income tax purposes, and also for U.S. transfer tax purposes, okay, Fred and Wilma are treated as if they own all of those assets directly themselves. So the trusts really have no consideration outside of their paper during their lifetime, unless either one of them becomes incapacitated or incompetent during their lifetime, okay? So that's very important to understand. So first of all, since this is an election year here in the United States and we're concerned about a potential change in administration, we don't know what's going to happen in November, where the parties see each of the political parties and each of the candidates running for president of the United States have drastically different views on the estate and gift tax and how it should be applied. So right now we have a party in control, the Republican Party here in the United States, that passed a law in 2017, the 2017 Tax Act. And under that current law, they doubled the estate tax exemption from a $5 million base to a $10 million base, and it's increased each year due to inflation. Okay, so we have an inflationary increase at the beginning of this year, at the beginning of every year. Right now, the current level, based on that $10 million base, is $11,580,000 per taxpayer. You have to be a U.S. resident, permanent resident, or a U.S. citizen to claim that. So under our facts, Wilma cannot claim that any part of that exemption, no matter regardless of where her assets are. Fred is, regardless of where he lives, he's taxed on his worldwide assets, regardless of where they're located. So even though he hasn't lived in the United States in years, every asset that he owns and it's held in that revocable trust is potentially includable in his estate. So we have that $11,580,000 base to work with on Fred's side, but we also have to remember that under the current law, that's scheduled to sunset and revert back to a $5 million base. It'll be somewhere around $7 million in 2025. Now, if the Democrats were to win and take office, notice the inflection of the cough, but if the Democrats were to win and take office, okay, their proposal is to move that $11,580,000 exemption all the way down to $3 million. Okay, so that's important to understand. Now, Wilma on her side has no lifetime exemption, and when she dies, she actually has a $60,000 exemption from estate and gift tax here in the United States, but much less because she's not a U.S. person. Okay, so that's important to understand. So the first thing that I would want to do is make sure that Fred and Wilma are aware of the issues involving that exemption right now, and we're advising all of our clients, regardless of where they live in the world, if they're U.S. citizens, to take advantage of that exemption now in case it's lost. Because the law is very clear that if you take advantage of it now, okay, even if the law changes after the fact, you can't go back and they can't impose a penalty on you for taking advantage of it now. So our advice to our clients is to make sure that you do that right away. And there's a whole number of ways that you can do that, including using trusts and jurisdictions that would enable your client Fred in this situation, along with his family, to remain a discretionary beneficiary of the trust. And we do that in a number of different places. Not every jurisdiction, particularly ones here in the United States, are compatible with that, but jurisdictions around the world, as well as at least 17 states in the United States, allow you to create trusts like that and remain a discretionary beneficiary. So that's very important to understand. We need to make sure that Fred understands it, that there may be a limited opportunity, and even if there was a change in administration going into next year, okay, even though when we get to January, the $11,580,000 exemption scheduled to increase based on cost of living to $11.7 million. Okay, but even if that happens, they can make any legislation that's passed throughout that year retroactive to January 1st. So the time to do the planning would be this year, not next year. Okay, so there is, at least again, if we get to November and there is a change, you do have time to take advantage of that. There's not going to be a change this year, but we realize there could be next year. So we're advising all our clients to do that right now. So that's number one. Wilma, on the other hand, okay, we need to make sure, and this is again very general because I don't want to take up too much time here, but we need to make sure that any asset that she has, and she's what we call an NRA, a non-resident alien, don't have a U.S. situs for U.S. estate and gift tax purposes. Okay, and so that would be important to go through her holdings. So for instance, if she owns an LLC, a single member LLC that owns a stock portfolio here in the United States, that would concern me, okay, because we don't know the status of how a U.S. LLC would be treated outside of a potential treaty that would change the treatment. So what we would want to do there is we always wrap U.S. real estate that's owned by an NRA. We wrap marketable securities, which actually U.S. stocks, companies, either private companies or even companies traded on a public exchange, if they're U.S. stocks, those have a situs here in the United States for U.S. estate tax purposes. Sometimes not for gift tax purposes in regards to stocks. Real estate always has a situs here. But you have to make sure that Wilma's assets, and again, with prudent planning and advanced planning, you can actually change the form of the way an individual, an NRA in particular, like Wilma, owns her assets to make sure that she doesn't have any U.S. situs assets. So even someone purchasing or someone that owns real estate here in the United States can own it in such a way that it's not considered a U.S. asset. Okay, and what's the easiest way to do that? Well, one, form a company, a foreign corporation in a jurisdiction such as Switzerland, maybe, or the Bahamas, the Cayman Islands, name your favorite Caribbean jurisdiction, the British Virgin Islands. You form a corporation there, and that corporation in one form or another acquires real estate or acquires U.S. stocks, U.S. portfolio here in the United States, or owns an interest in the U.S. corporation. Okay, and that's one way of avoiding estate tax. There's a whole slew of other ways we go about it, taking into account the fact that corporate tax, depending upon again who is in office, may be at certain rates. Right now, our capital gains rate here in the United States is at 20%, and our corporate tax rate is at 21%. So the differential there really doesn't make much of a difference right now. So we're cognizant of that, but obviously there are some proposed changes. And going into an election year again, we have to take the long-range considerations into account in advising clients and what the potential changes would be. So that's on the one side. Okay, so you have the U.S. estate and gift tax again, which can be a very expensive hit. Okay, with regards to Fred, to the extent that he doesn't use up his exemptions, and obviously we recommend he does, he can leave his remaining estate to Wilma when he dies in a form that would qualify for the marital deduction, but it has to be in a very restrictive format, what we would refer to as a qualified domestic trust. And when Wilma passes away, those assets again are, we look at Fred's original estate tax, and we look at Wilma's death, and you go back and then you pay the estate tax on the assets that are in the Q-Dot trust. And the Q-Dot trust allows for all of the income to be distributed out to Wilma on an annual basis, but if there's any principal distributed out to Wilma at any time to support her lifestyle or whatever, that's when you have the estate tax that's due here in the United States on the distribution of principal at that time. So there are mechanisms there. With Wilma, okay, she can leave any of her assets to Fred if Fred were to survive her, in a format that qualifies for the marital deduction, so she can give Fred an outright gift of those assets if there's any that have a U.S. situs at her death, and she gets 100% marital deduction for that because she's married to Fred. Fred can't do that the other way around, because we tend to discriminate against individuals who are not U.S. citizens here when we're looking at the estate and gift tax. So that's important to understand. Then on the income tax side, I see some concerns, or might raise my eyebrows, and I think need to be addressed here. First of all, Fred is taxed on his U.S. on his worldwide income regard, just like he's taxed from a U.S. perspective on his assets worldwide on the state gift tax side. From an income tax perspective, he's taxed on his worldwide income. Now, he may get credits in different places where he lives for taxes that he pays locally, but he has to pay tax here in the United States to the extent that the credit doesn't, the tax imposed in other jurisdictions isn't as high as would be imposed here. Now, the one major thing that concerned me was Fred has a Bvi company that owns a stock and bond portfolio. Okay, not sure how that happened, and may have been the product of some bad advice years ago. But that Bvi company is a foreign personal holding company, so it raises all sorts of issues with the income tax. And then when he dies as well, that's an asset that's going to be includable in his estate. And we've wrapped the the portfolio marketable securities inside of that BVI company. We're not going to get a basis adjustment. That's a highly appreciated portfolio. We're not going to get a basis adjustment on the assets inside of the BVI company at Fred's death. You get a basis step up in the shares of stock of the company, but not in the assets inside the company. So one of the problems that we have to address either during Fred's lifetime, and there's a whole analysis here, and certainly after he passes away, is what to do with that company and how to treat it. Now, hopefully, maybe we're not aware of the facts here, but I'd ask Fred one more question on that. I said, with that BVI company, or that BVI Limited that was formed a number of years ago, did you happen to make a check-the-box election? Okay, and if Fred made a check-the-box election, or his advisors told him to do that, then it would be a look-through entity, or an entity that's ignored for federal income tax purposes, and we wouldn't have the income tax issues I just raised, the foreign personal holding company issues. We wouldn't have the corporate shell that we have to be concerned with, and the assets inside the corporate shell. So I'm hoping the answer to that question would be yes. We actually made we made an election. We treat that as a disregarded entity for U.S. income tax purposes. So that's important to understand too. After Fred passes away, if we kill Fred off first, we can kill Wilma off first, or we can kill Fred off first. In our second set of facts, we actually killed Fred off first. Okay, if we put assets in trust for Fred and for Wilma and Fred's descendants, then you're going to have an estate tax liability here immediately on his assets. So you have to make Wilma the sole beneficiary in a QDOT in order to defer that estate tax liability until Wilma passes away.
Thomas, how about you on the Swiss side?
Yeah, thanks, Darlene. Happy to give you a quick overview of what Swiss tax aspects there are around the trusts and also the companies. I mean, some of the topics were also already raised by Jonathan, and we have, in Switzerland, we have more or less the same questions around those points that Jonathan already raised. I've prepared a few slides on how different types of trusts are treated for Swiss tax purposes. What should be noted is that the concept of a trust is basically unknown to Swiss law. That's a foreign legal concept where Swiss tax law has for a very long time struggled a lot with, and the Swiss cantons, who are in charge of assessing personal income and wealth taxes, they develop different practices around how to tax a trust structure. And not until 2008, the Association of Swiss Tax Administrations came up with a circular letter, an analysis how to treat trusts in a uniform way. And I'm giving you a bit of a snapshot of how this taxation looks like.
Okay.
So we have, in the case at hand, we have a revocable trust, and this is actually almost the easiest situation for Swiss tax purposes, because in a case where the trust is revocable, there is, from a Swiss perspective at least, there is no alienation of assets, and this means that there is not, by setting up such a trust, there is no taxable event. The settlor continues to be liable to income and wealth taxes on all trust assets and the income that those assets generate. And in the case of distributions to the beneficiaries of such a trust, this is regarded as a gift by the settlor to the beneficiary. Then we have to look at cantonal and municipal gift taxes in Switzerland. But this is only relevant in cases where the settlor is actually resident in Switzerland, which is the case in our case study. Mm-hmm. So basically, where we have a revocable trust, everything stays the same as if the settlor held the assets directly. As opposed to that, if you have an irrevocable fixed interest trust, the settler basically alienates his assets, and this alienation is considered a gift by the settler to the beneficiaries. That means that at the point of time where the trust is set up or contributions are made to the trust, cantonal and municipal gift taxes kick in, basically again in case where the settler is Swiss tax resident. And from that point of time on, because it is fixed interest, all the beneficiaries have to bring to tax their relative shares of the assets and the income on those assets. On the other side, any distributions to the beneficiaries are then are subject to ordinary income tax, as if this income were held directly by the beneficiaries, not by the trust, but a direct income from investment assets. And there is also a benefit to that, because unlike most other countries, Switzerland has a regime whereby private capital gains are exempt from income taxes. And that means that if the trust generates capital gains and distributes such capital gains to the beneficiaries, they would not be taxable. And the same is true for distributions of the trust capital. So any distribution of capital will again not be regarded as taxable income. It gets quite different and difficult when it comes to irrevocable discretionary trusts, because then there is a lot of different treatments depending on where the settler is resident and what type of tax regime he benefits from. In case we have a Swiss resident and ordinarily taxed settler, the treatment is more or less the same as in the case of a revocable trust, i.e. The trust assets and income of such trust assets are still attributed to the settler, and only upon his death any inheritance taxes would be levied. When we have a foreign resident settler and an irrevocable discretionary trust, the situation is quite different, and in that case, Swiss tax law is not so much concerned about keeping the trust assets in a taxable environment. So Switzerland doesn't really care in case of a foreign settler whether the assets are attributed to such foreign settler or to any nirvana, i.e. a tax nowhere. That means that in this case, the trust assets are no longer regarded as part of the settler's taxable wealth, and the contribution by the settler to the trust is instead regarded as a gift by the settler to the trust. This doesn't matter as long as the settler is abroad and the assets are also somewhere abroad. But in case of Swiss real estate, this can become really expensive, because in that case, gift tax would be levied on the value of that real estate that is transferred to the trust. And because the trust is not a related person, basically, that benefits from lower gift taxes and inheritance taxes, the maximum gift and inheritance tax would kick in that case, or at least in many cantons. There are some cantons who still look at the beneficiaries. If they are all children of the settler that would basically benefit from a gift tax exemption, then they might also grant an exemption on such a case. So that means in the case of at hand, we would have both this Nevis Trust and the US Trust would be regarded as transparent entities, and Swiss tax would look all the way through to the LLCs, to the funds, limited partnerships, etc. And the question then is, how are these LLCs, etc., treated for Swiss tax purposes? I will start with the LLC. This is also a bit of a tricky question, because same as in the US, an LLC can be regarded as a corporation on the one side, but also in some cases as a transparent or disregarded entity. again, the Swiss Association of Tax Administrations has set out the treatment of LLCs in a guideline some years ago. An LLC has most of the features of the Swiss equivalent of a GmbH, eine Gesellschaft mit beschränkter Haftung. And the GmbH is subject to corporate tax in Switzerland. So based on internal Swiss law, an LLC should actually be treated as a corporation, and any distributions of an LLC should be treated as dividends, which might benefit from a lower taxation than other income at the level of the Swiss individual. Now, there has been different exceptions to that rule. First of all, the Swiss Supreme Court has, in 2 recent rulings, overruled this practice by the Swiss Association of Tax Administrations, and they said, or they put more weight on the treatment of the LLC in the US in order to avoid any hybrid tax situations. So in cases where the LLC is treated as a disregarded entity for US tax purposes, these days you should assume that most likely the LLC will also be taxed as a transparent entity for Swiss purposes, which means that any assets and income that the LLC generates or holds are directly attributed to the Swiss taxpayer. Now, in case of an LLC that holds US real estate, there is obviously the exemption that foreign real estate is not subject to Swiss taxes. So the rental income whatsoever that the US LLC generates will most likely not be taxed in Switzerland. The same is actually true for the situation which we have with the limited partnership in the UK. In that case, we also have UK real estate that will not be subject to Swiss taxes. In the case of Wilma's Trust, there is an LLC that holds art. Now, art is not attributed to any other country. This is considered a movable asset. So whenever, for instance, this LLC generates an income from the art, from selling the art, or I don't know, renting it out, that would basically be taxable by Wilma. Yeah. And then the last bit of the structure that I would like to discuss at this point is the 2 Bvi corporations that we have in the structure. Again, the situation is a bit similar to what Jonathan discussed with respect to the US. It's questionable whether these entities should be recognized from a tax perspective. Now, Switzerland does not have any check-the-box rules, but we have anti-avoidance rules and the usual usual rules about tax residence and management and control. In case there is such a corporation in BVI holding stocks and bonds, someone needs to take the decisions around the investments, what to invest, what to sell, what to do with the income. And Switzerland puts a lot of emphasis on the day-to-day business of such an entity, unlike the US treatment, which is more looking at what the board of directors, where the board of directors are taking their decisions, etc. If we look at the day-to-day business of this corporation in BVI, most likely those decisions will be heavily influenced by Fred or by Wilma. And so there is reason for concern that this corporation or these corporations will be regarded as Swiss tax resident, which would mean that they would become subject to Swiss corporate taxation. On the other hand, the upside would be that these entities could benefit from the Swiss treaty network, i.e. Any relief from withholding taxes on dividends and interest income from these stocks and bonds could be, there could be a relief.
Yeah, I've got a question for you because I'm very interested in the Swiss's interpretation of those US LLCs. That's good to know. Very good to know. Thank you. But I got a question for you. On those U.S. LLCs, if they're considered to be disregarded entities, does that mean that Switzerland would look to the trust itself, or would it look to the settlor of the trust because it's a revocable trust?
Well, I mean, the LLC as such would be attributed to Fred as if there wasn't any trust, because Switzerland looks through the trust. But then if the LLC is transparent, it looks further through the LLC down to the investment of the LLC. And again, in case of foreign real estate, that doesn't matter too much because that's then not taxable in Switzerland. But if we have the other situation like the art, or if the LLC held any stocks or bonds, then those stocks or bonds would be treated as if held directly by Fred and hence taxed accordingly.
Wow, interesting. Thank you very much. That's brilliant. I appreciate it. Adam, how about you on the UK side?
Thank you, Darlene. On the UK side, after hearing Thomas, let me start with saying that a disposal to a trust, whether it's revocable or irrevocable from a UK tax point of view, is very much a taxable event that can have tax consequences depending on the assets that are being transferred to the trust, the terms of the trust indeed, and the domicile and residence of the settlor. A trust that then goes forward itself being a taxable entity, potentially for income tax, capital gains tax, and inheritance tax. And then there are also potential income tax, capital gains tax, and inheritance tax consequences for anyone recipient of benefit from the trust. Looking at what we've got here, the primary thing that one needs to look at, and indeed always needs to look at, is the domicile of the settlor or settlors. From a UK point of view, wouldn't want to go on too long about it, but you're essentially looking at the place of the person's permanent home. They inherit an original domicile from their father usually. I think what we can hopefully safely assume here is we've got two Swiss domiciles, one perhaps with a domicile of choice in Switzerland, and one with a domicile of origin in Switzerland. But the important thing from the UK angle is they are non-UK domiciled, currently at least. Domicile is important not only looking at it in the creation of the trust, but also afterwards, if they become UK resident, potentially their domicile can change either through their own mindset as to where they might want to live permanently, or because they spend more than 15 years, which I see further down the case scenario, in the UK as UK income tax residents. So that always needs to be kept under review, particularly if additions might be made to the trust. The next thing one wants to look at is the terms of the trust, and we've got revocable trusts here. UK tax does recognise revocable trusts as trusts, but one always needs to look at them carefully, particularly in the context of Wilma's trust, where she's described as centrally managing and controlling the trust, to consider whether the UK revenue would actually consider it a trust rather than just a trust on paper, actually factually and for tax purposes a trust. So what are the terms of the trust? Has the settlor retained so much control that it isn't anything more than what we would call a bare trust or a nomineeship, and they are in fact the owner for all tax purposes, at least, if not other legal purposes. Again, I hope we can assume that we have revocable trusts here that are indeed trusts from a tax point of view. Turning to that centrally managed and controlled, particularly for Wilma, again, the next thing one wants to look at very carefully is who are the trustees, both on paper and factually, who makes the decisions and where are they resident? Because you're not going to have a non-resident trustee if Wilma is the one that centrally manages and controls it, and she comes to the UK, then potentially you've got a UK trust with lots of further UK tax issues. Again, I'm going to assume for this purpose, otherwise could go on much too long, I think, that it is an offshore trust, as we would call it, even when Wilma and Fred, who actually sadly seems to never quite reach here, but did intend to reach the UK, arrive in the UK. So the trust, while they're non-UK resident for that period, because they create it when they're non-UK domiciled, can be very beneficial as far as UK tax is concerned, most of the assets within the trusts actually have not got a UK situs and have been organised in a way to limit that as much as possible. But what we do have in Fred's trust is some commercial property held through a partnership, I think a limited liability partnership. So that there are tax implications there. The income will be, if assuming the commercial property does produce income these days, will be taxed on the trustees as their partnership income comes through, because LLPs are transparent from a UK point of view. The capital gains tax is now payable even if that LLP, which it probably is a non-UK LLP. Non-UK residents now pay tax not only on capital gains tax, not only on residential properties, but also on commercial properties going forward. So that would be something for them to think about. And then finally, inheritance tax. Again, structures have become looked through as far as UK property is concerned. He fortunately has commercial property, and that so far is not subject to that look through, only residential, but that could change in the future. So the other question I know you're interested in relation to the trust is the LLCs. That's going to be relevant, I think, in this scenario once one of them rather becomes UK resident. LLCs from a UK tax point of view are generally treated as opaque. However, in respect of US taxpayers, there is provision in the US-UK double tax treaty where that can be seen as transparent, provided it's seen as transparent in either the US or the UK, so the US here, and the recipient of the income pays US income tax. We do have the scenario here where actually possibly the recipient of the income is not the actual, is not Fred, it's trustees instead, which does need to be thought about, but LLCs are beginning to be recognised by the UK in respect of US taxpayers at least as transparent. Now they come, or sadly perhaps only Wilmer comes to the UK. They've got a very beneficial structure because they created it. I'm assuming it was after 2006, just to keep us out of some more complex rules, but after 2006, but before they came UK resident. First of all, that means they certainly cannot have been UK domiciled when they created their trust. And so it becomes what's called a protected settlement, provided they maintain their factual non-UK domicile whilst they live here. That would have to be looked at because the scenario talks about they've come here to live. I think they move here to spend more time with their grandchildren, but possibly once their grandchildren have grown up and start moving around the world, if Wilma at least is still alive, they would intend to return. She would intend to return to Switzerland, which would help maintain her non-UK domicile. So looking at her as a non-UK domicile but UK resident person, what she's got is a protected settlement, first of all, which means that the income and capital gains, whilst they are kept within the trust, are not taxable on her. If they're distributed, then if they're foreign income and gains and received offshore, then and distributed to her, then she can consider claiming the remittance basis of taxation in the UK, which is perhaps a little outside the scope of this particular talk, as we're talking about foreign grantor trusts primarily. But that would mean that she can protect even that income for up to 7 years without paying any further tax liability if she doesn't bring it into the UK. So capital gains are treated in the same way as the income. Inheritance tax, provided there's no UK assets within these structures, then there is no inheritance tax in respect of the trust, so long as she was non-UK domiciled when she created it, and she doesn't change. Well, actually, even if she does change her domicile, it will still be excluded from UK inheritance tax, and that will be for the life of the trust. So that can be very beneficial to her, avoiding not only a charge every 10 years potentially on the trust assets of 6%, but also a 40% charge on her death. So the other thing in relation to the UK trusts is she has a UK resident daughter and presumably some of the grandchildren as they're moving here. Any distributions to those grandchildren, whether perhaps indirectly via Wilma, hoping to claim or avoid tax because she doesn't necessarily pay tax on the distributions, that would need to be looked at very carefully because that would probably be taxable, and any direct distributions to her, to the daughter or the grandchildren, would also suffer tax in respect of income and gains made by the trustees.
Excellent, thank you very much. Sarge, how would you like to talk about
Absolutely.
what compliance these people are looking at from a U.S. tax point?
And a fair amount. I think by the time Fred and Wilma have come to me, they've been through Jonathan, they've been through Thomas and Adam, and the advice notes and various documents are in place. At that point, I feel my life is slightly easier because I'm following the advice being given from the legal aspect. But there is a huge amount of compliance to consider here. And, we shouldn't forget particularly from the US side, failure to file the requisite forms carry with it significant penalties. In Fred's case, being a US person, he is the settlor of a foreign trust. In this case, we know and we've established it is a foreign grantor trust. Fred, or the trustees in this case, have an annual requirement to submit a Form 3520A, which effectively highlights the activity of the trusts, gives the IRS basic information surrounding the trust. And part of that 3520A is establishing to Fred the income and gains he needs to consider as part of his income tax return. So the trustees will file that 3520A form annually, and Fred will file what's a 3520 form. And whilst it sounds, and it's very in name and in principle similar to the 3520A, it is a separate form, which Fred needs to file to show to the IRS he has this interest in the foreign trust, and he is the owner of that trust. And those two forms are important. Alongside that, as part of Fred's routine personal income tax compliance, he would need to report any of the non-US accounts held by the trust on his foreign bank account reporting form. Again, failure to file that form carries significant penalties. You can almost sort of say with certainty for the US side, a form in respect of a foreign interest, if it's not submitted, there'll be a minimum $10,000 penalty involved. And if we were having this conversation, 10, 15 years ago, I would feel fairly comfortable that we could, we wouldn't see many of these penalties, and we could probably argue a lot of these penalties due to various reasons. However, we are seeing quite a bit of interest on the IRS side into the compliance requirements for these foreign interests, and we're maybe not at this current time. I think things are quieting down due to the pandemic, but we are certainly seeing a bit more interest on the IRS side for compliance in respect of foreign entities. Touching on Fred's trust, and I know Jonathan sort of mentioned and highlighted a few issues with some of the underlying assets, particularly around the Luxembourg Mutual Fund. So we've got two issues there. From the US side, that fund is very likely, assuming there's no other major US party holding an interest in that fund, we are looking at the passive foreign investment company rules. That's a set of rules on the US side, which can mean holding that sort of investment is pretty tax adverse, particularly if this investment is held for a long period of time and has a significant amount of gain at the end of it. You can see huge effective tax rates being applied on the US side. The good thing is it will never be more than 100% of the gain, but I don't think that's any comfort to any investor. So there's a real concern there. On the UK side, while we're talking about sort of Fred's trust interest, I know Adam mentioned that this is potentially could be a protected settlement, but that Luxembourg fund, if from the UK point of view, it's what's known as an offshore income gain, so this fund does not feature on HMRC's reporting fund list, then although we do have a protected settlement for certainly the regular income and gains, I think HMRC have questioned, and certainly their opinion is the offshore income gains would still be taxable. So there is some thought we need to put there from the UK side, even though this very well may be a protected settlement. So that's more sort of Fred's compliance side. On Wilma, so she's not a US person, but on the basis the trust is a revocable trust, it's a US trust. I know that there's some debate on whether it's foreign, depending on the trustees, particularly from a Swiss point of view, that we need to think about. But if we go with, look, it's a grantor trust, but in this case, your grantor, your settlor is a non-US person. Therefore, you're only looking at, from a US tax point of view, potentially tax on any income and gains which are either effectively connected with a trade or business in the US or derived from US sourced income. So, on the basis the US portfolio is kicking off dividends, that there'll be some form of US tax due on those. Alongside that, with the LLCs, you've got information reporting for foreign nationals who have an interest in a US LLC over a certain percentage. So there's those things to think about. And again, compliance is at the forefront, certainly from my perspective. I think in terms of, certainly the sort of transfer issues. So particularly when Fred dies, and on a basis Wilma continues to, or she's come to the UK now. Certainly, as Adam said, we need to consider maybe some planning before, Wilma becomes deemed domiciled in the UK. Again, perhaps looking at the portfolios that are there, and what planning needs to be done, sort of within those.
I think the only comment that I would make on the compliance side is you got a controlled foreign corp with that BVI Corp, and so they, like you said, the penalties are quite high for failure to file on and report the subpart F income that will more than likely be generated by that BVI Corp for Fred, and then the US LLC, the Form 5472, which is a new filing requirement since 2017. But yeah, I think you're right. There's a lot of filing here, a lot of reports to be filed by both Wilma and Fred. So thank you.
I think, darling, you actually touched on that, with the Controlled Foreign Corporation, BVI. Although, as per Jonathan's advice, a check the box election has been made, so we're not concerned with that. But you're right, it hasn't been. Absolutely, and it's never too late to make that check the box election. I think the only sort of caveat there is, if there has been any inbuilt gain, any appreciation of that company, that will, create a phantom tax on the US side. There's always planning we can think about, we can consider, and we've got some good advisors here to help with those.
Well, I know we don't have a lot of time, but would everybody like to just unmute and have a discussion about any specific advice you'd like to give to Fred and Wilma? Thomas, any specific advice you'd like to give to Fred and Wilma?
Yeah, sit down quickly, because time is at a premium. One, Fred doesn't know he's dying soon in one of the scenarios, but we're coming to the end of a tax year this year that could potentially have significant changes in the U.S. for transfer tax purposes, and a loss of significant benefits to the wealthy. So we are very busy right now helping our clients move assets to structures that get those assets out of their estate and gift tax base. That doesn't necessarily mean you have to give up access to that wealth, but you just have to move it out of your estate and gift tax base, and that's important to understand. And then on the income tax side, Sarge, you hit on it. You need to make sure when you're dealing with foreign entities, foreign trusts, that you're in compliance. Because otherwise you can get some pretty, a lot of times you can remediate, you can address the problem if you missed a filing, but it's very scary when you get a letter from the IRS saying you owe us several $100,000 interest and penalties, which has happened before in this area.
Yeah, this is very true.
Absolutely, absolutely. And I'd just like to add to sort of Jonathan's point there. I think there is going to be a fair amount of planning to consider in this last quarter. Particularly, I think if we did, sort of get a Republican sort of politician in place, the new president, or what everyone's expecting, I think, the speculation is that income tax rates rise, the capital gains tax will go. So I think there's going to be a lot of planning back end of this year, particularly around potential disposals that need to be thought about. And then we've got to sort of maybe try and interlink that with some of the potential UK changes from the next budget. Fingers crossed it does go ahead. And some of the potential changes we'll see there, maybe an increase with CGT in the UK. So again, that might almost force your hand with your US UK clients for doing something in this sort of last quarter.
Well, I think you're, to be honest with you, this whole pandemic situation, I don't think there's very many governments who aren't going to be raising taxes, no matter who's in power. I don't think they're going to have much of a choice, whether the Democrats or the Republicans. A dollar's a dollar.
That would be correct.
The money.
Yeah.
They're borrowing from all they're doing is printing money right now. So we got to balance that budget somehow. Anyway,
they're going to have to create some new types of taxes, to be honest.
I think so.